Hi, everyone. Now it's time to jump to the other side of the balance sheet, and let's talk about accounting for liabilities. This is a subject that most of us think we know a great deal about. So let's see how our intuition translates into the accounting notion of a liability. Which of these events would give rise to a liability? Our plant manufacturing facility sits at the end of a major airport runway. We didn't build it there. The runway was expanded out as far as they could expand it. And we recognize that if an airplane undershoots that runway by enough, they're going to crash into our plant. Or the president of the company drinks and runs around. And for those of you that are not native English speakers, runs around doesn't have anything to do with running marathons. Your truck hits a school bus. Nobody's sued us yet. We are insured. You guarantee the debt of a weak supplier. You have a critical good that you need in your manufacturing process, and this supplier makes it. And this supplier comes to you and says, I'm having some financial difficulties. I really need to borrow this money to be able to continue in business. And you don't want to lend the money, but you are willing to guarantee the debt so that if the supplier can't pay the debt, you will. You lease a building for 20 years. You hire a president on a 3-year contract, or you borrow, agreeing to pay interest. Now, it's pretty clear that the amount you borrow is a liability. What about interest? All right. You may be surprised to discover that relatively few of these give rise to liabilities or give rise to liabilities at inception. The first two of these are risks, not liabilities. We can't account for risks. No accountant's crystal ball is that good. And so what we discover is that we attempt to mitigate risks. We insure against risks, but risks aren't liabilities. Now, the second to the bus accident and the guaranteeing of the debt, those are what we would characterize as contingent liabilities. And contingent liabilities may or may not be liabilities that belong in our accounting records, depending, we've decided, on the probability that the liability will actually have to be paid. For example, if we have an event that leads us to believe that it is probable that we're going to have to make some payments and that we can estimate the amount of those payments, then GAAP tells us that we book that as a liability. We debit some kind of loss and we credit estimated liability for. Now, again, we look to probabilities. If we think it's probable and our loss is going to exceed the amount of any insurance protection, then we book it. Now, if on the other hand, we believe that the probability is remote, that we've got a frivolous lawsuit against us, and it's very unlikely that anything will have to be paid, then under those circumstances, accounting theory GAAP tells us that we don't have to do anything, so long as the probability is remote. And if the probability is higher than remote, but not to the level of being probable, then under those circumstances we are required to disclose, that you would expect to find a footnote disclosure that would describe the situation and indicate the degree to which we believe that some kind of payment could possibly be required. So the second two are contingent liabilities, and we call them contingent liabilities because we need more information to be able to determine with accuracy the amount. These can be quite large, though. For example, when when the Exxon Valdez augured into the ground at Prince William Sound. In the quarter that happened, Exxon booked a contingent liability that wiped out the entire quarter's profits. And you can imagine what kind of number that looks like on Exxon's balance sheet, income statement, and the impact on balance sheet. So the first two were risks, not liabilities. The second two could be liabilities depending on our probability estimate. And we are required to reassess those probability estimates each year. Every time we prepare financial statements, we should reassess them. If our assessment changes, then we may change the way we account for them, move them up or move them down the probability scale with the resulting action. Now, the last three of the items that were listed here, interestingly enough, are not liabilities. The interest, the salary, and the rent are not liabilities at the time of the inception of the agreement. They're two-party executory contracts. That is to say that we have exchanged promises by entering into a contract, but nothing more has happened. And we've concluded that the best way to handle two-party executory arrangements is to book over time as the liability is incurred. So as time passes and interest charges grow, then we have a liability that we have to pay in accord with the contract. The salary item, you don't book 3 years of salary at the time he signs the contract or she signs the contract. We're going to book salary expense and any salary liability as services are provided. And rent, we won't book as a liability until the rental services are provided. So amazingly few of the things that we looked at are actually clean liabilities at the point of inception or the point of the action. So we've been sort of trying to divine what a liability is, and we've discovered a lot of things that they aren't. We're going to define a liability as the present value of a present obligation to provide future payments, goods, or services. Now, the first two words in the definition tell us the valuation principle. We're going to value these at their present value. The next few words tell us that it is a present obligation that gives rise to a liability. And in this instant, the word present here means existing, an obligation that has arisen. We may not know everything we need to know, but an event has occurred. That's a requirement for us to book a liability. And the liability could be to provide future payments, and many, if not most, liabilities require the future payments of cash, but they could also require the provision of goods or services. And if you recall, that's the reason that unearned revenue is classified as a liability. It's an obligation to provide future goods or services. Okay? Now, we have relatively little use of present value calculations in the measurement of liabilities, even though we define them as being the present value of a present obligation. And the reason for that is that we ignore current liabilities for purposes of present value. They're too short. We would gain so little real valuable information by discounting them in their measurement. And liabilities that are issued at a fair rate of interest are ignored. Now, we ignore them because if we add the interest for the life of the obligation and then discount at that same fair rate, you come right back to the present value. You come right back to the stated amount of the liability in the initial case. And so it hardly makes sense to go through that exercise. So long as a fair rate of interest is charged, then it'll simply be the face amount of the obligation. Where we do find, however, present value concepts and notions useful, we find this in the case of obligations that are issued at a premium or a discount. If I issue a debt obligation and that obligation is issued at a premium or at a discount, then I have a lot of evidence that I've issued a debt obligation with something other than a fair rate of interest charged. And we're going to see that we have to learn how to account for literally the premium or the discount and the impact that has on the carrying value of the debt. Okay, and we're going to do that in a separate discussion. IFRS and GAAP treatment of liabilities pretty similar. We do see, though, that under IFRS, negative cash is treated as a negative asset and left on the asset side of the balance sheet, so that if you overdraw your checking account, you'll wind up with negative cash. In the United States, we recognize negative cash balances as liabilities to the financial institution, an amount we have to pay, and we'll treat these as a bank overdraft, and a bank overdraft is going to be treated as a current liability in the United States. We treat contingent liabilities a little differently. Under IFRS, liabilities are required to be recognized if the probability is greater than 50%. The language in the standard under IFRS is that it's a more likely than not standard, which means that if you think the probability is 50% or 55%, 60%, then you book a liability. Under GAAP, we use a probable notion, that is the word that's used in our standards, and as a consequence, we look for a probability that's somewhat higher than the 50% cutoff. We might look for something closer to 70% in the United States. Now, the truth of the matter is that probable and more likely than not give us indications, but they're not red lines, lines drawn in the sand so that we would know exactly when. So a lot of judgment is still involved to try and determine whether the likelihood of something happening is probable or not. And in those instances, we will tend to look to specialists to assist us in our efforts. Okay, so that's how we treat liabilities from both an IFRS perspective and a GAAP perspective. We'll take a look at how we handle bonds and premiums or discounts in another presentation. Let me know if you have any questions. I look forward to hearing from you.